Our stocks overvalued today. Hello everyone and welcome to mangomonkey Learns Money. In today's video, I will be discussing the frothy valuation of the US stock market today and try to work out whether I believe it is overvalued or not. This video was prepared in late October and I will be referencing an article from Seeking Alpha. In late October, the current PE ratio of the S&P 500 index is 28 times, and this means the stock market is priced at 28 times its average yearly earnings. In other words, it takes 28 years to recoup your investment if you cannot find another buyer to offload the stock to. No. This kind of PE ratio is around 2 times the historic median of 15 times earnings for the S&P 500 index. To put it another way, stocks are currently trading at a 3.5% earnings yield. If you are a property investor, this is like saying the rental yield is 3.5%. If it was an apartment worth $1 million, it is only rented out for $673 per week. For a real estate property, this earnings yield is actually quite decent because property is a safe asset class and the yield tends to be smaller. But stocks generally have a higher earnings yield because they are risky. This sort of earnings yield is the lowest in a decade for the S&P 500. Historically, there has not been a single period in which a 25 times PE ratio was sustained for a long period. Eventually, PE ratio has always come crashing down to more reasonable levels. Now, high PE ratio can sometimes be justified if the earnings are growing rapidly. So you are paying more based on today's earnings because you know that next year's earnings will double, and the earnings will double again every year after that. But there has been a lot of technological innovation over the last decade, and the pace of innovation is slowing down because there is only so much you can improve on. It is easy to make your business more productive if it is not productive to begin with. But once it is already running efficiently, there is only so much marginal improvement that you can make. It becomes harder and harder to improve and grow the company earnings. In addition, a significant part of the earnings growth in the past has come from reduction in interest rates. A lower interest rate reduces the interest expenses of most businesses, resulting in higher profits. Interest rates in the US in the 1980s were more than 10%, and now the interest rate is pretty much 0%. Free money, everyone. From this point onwards, it cannot really drop further, so there is one less source of earnings growth in today's environment. Another point to note is that the US is currently in a recession with double-digit unemployment. It's still going to be a few years before consumers can spend and companies can grow again. Therefore, I believe that the US stock market is currently overvalued. It doesn't mean I will liquidate all of my stock holdings, but I'll start to reduce some of them, especially those for which I have made a capital gain or a profit. If you enjoyed this video, please do help out by clicking the like button. Share this with a friend. I'll see you next time.